Companies Act, Section 378 ZF, Internal Audit Requirements for Producer Companies. In order to ensure that the financial and operational activities of a producer company are carried out in a transparent, efficient, and compliant manner, the Companies Act, 2013, under Section 378 ZF, imposes a statutory obligation on every such company to conduct internal audits of its accounts. Internal audits serve as a critical internal control mechanism that helps detect errors, prevent fraud, and improve overall governance and risk management practices. This provision recognizes the importance of regular internal reviews, particularly in entities like producer companies, which are often formed by small-scale producers, farmers, or artisans who may pool resources for collective economic benefit. It ensures that such companies adopt proper accounting practices and remain financially sound and accountable to their members. 1. Statutory mandate for internal audit. According to Section 378 ZF, every producer company is required to conduct an internal audit of its accounts. This is not a discretionary activity but a mandatory compliance requirement that must be fulfilled as part of the company's ongoing financial governance processes. The term internal audit refers to a systematic, independent examination of the financial and operational activities of an organization, conducted to evaluate and improve the effectiveness of risk management, control, and governance processes. In the context of producer companies, internal audits help assess the accuracy of books of account, the effectiveness of internal controls, the transparency of transactions with members and third parties, the efficiency of production or service delivery processes, and compliance with applicable laws, rules, and policies. 2. Frequency and manner of conducting internal audit. The internal audit must be carried out at such intervals and in such manner as may be specified in the articles of the producer company. This gives the company some flexibility in determining the audit frequency, example, quarterly, half-yearly, or annually, and the procedural framework for conducting such audits, as long as the process is consistent with good governance practices and approved by the members or board. Producer companies should ensure that their Articles of Association, AOA, clearly define the timeline or frequency for conducting internal audits, the scope of the audit, i.e., whether it covers financial statements, internal controls, compliance, procurement, sales, etc. The reporting mechanism, example to the Board of Directors or Audit Committee, the procedures for follow-up on audit findings and recommendations. This requirement underscores the importance of embedding audit procedures within the company's governance documents, making internal audits a part of the company's routine functioning rather than a reactive measure. 3. Appointment of a qualified chartered accountant. The law further specifies that the internal audit must be conducted by a chartered accountant, as defined under Clause B of subsection 1 of Section 2 of the Chartered Accountants Act, 1949, Act No. 38 of 1949. This ensures that the audit is performed by a professionally qualified individual with the necessary training, knowledge, and ethical standards. A chartered accountant, CA, as per the Chartered Accountants Act, is a person who is a member of the Institute of Chartered Accountants of India, ICAI, has passed the prescribed examinations and completed required training, and holds a certificate of practice in case of practicing CAS. By mandating that the internal audit be conducted by a CA, the law guarantees that the auditing process is objective, thorough, and reliable, thereby increasing confidence in the financial integrity of the producer company. This also helps in early detection of accounting or financial irregularities, if any, and aids in timely corrective actions. 4. Purpose and benefits of internal audit for producer companies. Internal audit plays a crucial role in enhancing the efficiency and accountability of producer companies. Some key benefits include Strengthening internal financial controls ensures proper checks and balances in accounting, procurement, and cash management. Enhancing transparency promotes clarity in dealings with members, customers, vendors, and external stakeholders. Improving compliance ensures the company adheres to applicable provisions of the Companies Act, tax laws, and other regulatory frameworks. Identifying inefficiencies helps pinpoint process gaps, wastage, or misallocation of resources in production or service delivery. Building stakeholder confidence demonstrates a commitment to sound governance, which is critical for gaining trust of financial institutions, government bodies, and members. For more details, contact us.